Hello, everyone. Hi, everybody. This is JD, your favorite CPA. I am making this live to bring some good news to you. Actually, I'm gonna spill some beans here. The tax season officially started yesterday. What does that mean? That means the IRS started processing, accepting, and processing your tax return as of yesterday. So, meaning from yesterday, if you expect a refund, the day begin from yesterday to until the first day of the disbursement. Anyway, every tax season, if you know this is a very busy season for any tax professional, CPAs, and you have some EAs out there. So, what you should know this tax season. First of all, I want you to know and do not wash. I understand many people do expect a tax refund. So you want to wash to do your taxes. Do not wash. The first thing you should collect your documents. You should think about it. What are the taxable events that occurred to you this past 2023 and collect those documents? For instance, did you change your filing status? Did you get married? Did you have a child for 2023? Right? So those are taxable events that will change your your income or your tax liability, because if you had a child in 2023 and you did not have a child prior to that, so that will change your filing status, you know, assuming you were single prior, and then that will change it to being a head of household. And then you can be eligible to claim some tax benefit for your child. So you should collect your documents. You should think about any type of events that are taxable. Did you purchase a new home? So you should have your closing documents, as long as the 1098 that the financial institution will provide to you in order to deduct your property taxes, your mortgage interest, your insurance premium if you're available to it, and stuff like that. Did you go to school? So those are, you didn't go to school prior to 2023, and 2022 you started school. So those are the type of taxable events that you may have, and that will change your taxable outcome. All right. And that's the first thing. And the second thing, I said to people, I have newcomers calling me every year, and my question is always, why are you changing your CPA? And this is crucial to me, because I do not want to have everybody as a client. And just like not everybody wants me to be their CPA, I may not be the best fit for you, and vice versa, which is totally understandable. And another thing I want you to bear in mind, many people, there's a misconception when you file your taxes. You file your taxes to pay your fair share to the government. Since the inception of the federal income tax, I think that actually occurred in 1861 during the Civil War, right? That was the first time the United States citizens were imposed a federal income tax. There were taxes before, but the federal income tax, United States until 1861 during the Civil War, was a federal income tax free. Yes, there were excise tax, there was tax on the alcohol and the state tax, sales tax, there were tariffs. and the famous Boston Tea Party taxes, stuff like that. I'm not a history um, um, professor here, but just to go back and give you a little background. So the misconception is people, you file your taxes to make money. You should have a refund. No, at this time of the year, you should know. You should know if you are going to owe the IRS or if you are going to have a refund. You should, right? So this is not the time to go to your CPA and say, why do I owe? Oh, and do and you go around trying to fish, or trying to find out who can get you the best refund if you're entitled to one. If your taxes is done properly, it's basic arithmetic. It's the tax law that is applied and with some calculation. If it's done properly, meaning applying all the legal credit or deductions based on your status circumstances, you should have the same results everywhere that you go. So going around trying to find out if you can get a greater refund or reduce your tax liability, you are putting yourself in a situation where some unscrupulous professional, or I wouldn't even call professional, unscrupulous people, or some charlatan can actually do you some harm on your tax return. And then you will receive those letters from the IRS, for audit and stuff like that. So be aware of that. And also, there are some major dates you should all you should be mindful of. Of course, starting January 15, that was the last quarter to pay your underestimated taxes for 2023. So if you're self-employed or not enough taxes were being withheld on your W-2, especially for self-employed people, so you by law you have to submit your quarterly estimated tax payment. So January 15 was the last quarter, was the deadline to avoid underpayment penalty. So you have January 15. That's a major date. It's already passed. Of course, you had yesterday, which is the starting of the official tax season, where the IRS started accepting and processing your tax return. I did file some return prior to that, but they were transmitted and probably being held in by the transmitter. But yesterday, everything actually um, uh, started going to the Internal Revenue, and then since yesterday, many of us are getting those acknowledgement that the returns have been accepted and stuff like that now are being processed for refund. Well, now you also a major date for business taxes. If you own a business, I'm not talking about being a single member LLC where everything goes on your Schedule C. I'm talking about a partnership return. If you have an S corporation return, a C corporation return, March 15 is your deadlines. March 15, that's another major date, is your deadline. And if you intend to file an extension, you should talk to your CPA ahead of time, because when you file the extension, if you're gonna owe any taxes, you should file your extension with the tax due or the estimated tax that will be due. So March 15. Also, you have April 15, which is the deadline for your individual tax return. And it does apply also if you know you're gonna file an extension on April 15 for your personal tax return, you should talk to your tax advisor professional ahead of time. And personally, I want everybody to write me, because I'm not filing an extension to you by default. You may not be returning to me. And also there's a fee on at my office for an extension. And because it takes time. Remember, the fact that you file an extension, if you owe taxes, you should be paying your taxes with your extension or make an estimated payment with your extension. An extension to file your tax, 6 months extension, is not an extension to pay. Even with an extension to file, if you owe taxes on April 15, interest and penalties kicks in that day, April 15. So you file an extension to file, it's not an extension to pay. I think it is a big misconception and people don't understand those technicality. And this is something you should bear in mind now. I want to go back something very, very important that, and I know it's been a situation. Many of us get our medical insurance to the marketplace, either the federal or the state. In New Jersey and New York, I know you go to the New Jersey marketplace in New York. The federal will actually divert you to the applicable state that you should buy. If you get your medical insurance through the marketplace and you did receive some sort of advance payment premium from the federal, do not rush filing your tax return without your 1095-A. The return will be submitted. It will be delayed. If you expect a refund, it will be delayed. Go online on your account, on the platform you actually get your health care, download that 1095-A. That's why you should not be rushing. You should take your time. You should actually organize your documents, have an initial conversation with your tax preparer or your CPA. And if you're a new client, you're changing your CPA or you're changing your tax advisor or your tax professional, bring a copy of your prior year tax return for many reasons. You want your new CPA to go over the previous year first to make sure that your information is correct on your new return. You're a new client. They do not know much about you. The prior return will give your new advisor an idea of the type of return, your tax situation, and can start a conversation if anything has changed from prior year to this year. And most importantly, if you had some carried over credits, losses, some people have rental losses that reach the limitation that carry forward. You have a depreciation on your tax return. You need to have what is the basis of those assets. So you need to have your prior tax return so that everything is carried over to the new year in a very accurate manner. All right. So that's the reason I'm telling you, do not rush. Take your time, think about it, organize, have a conversation with your CPA, have a conversation with your tax advisor, your tax preparer, so you know exactly what to bring if you're missing anything. I went over the dates. So the major dates you should bear in mind. Most importantly, if you're gonna owe taxes, do not delay filing. I know many taxpayers, because they're gonna owe, they're not getting a refund, they delay filing. That's where the issue, the tax matter begins with the IRS. You should file no matter what, because the largest penalty on your tax return is the fail to file penalties. It's 5% monthly on the tax liability, and up to 25% of the total taxes that you owe. And with not taking into account, if you didn't pay, there's the underpayment penalty, there's the interest on that. If you underreported your income, there's underreported income penalty, and so many. So everything begins with filing. Even if you owe, you file your tax return. And why do you owe? I think there's a general consensus. People are kind of like afraid of tax planning. Tax planning does not truly take a lot. As I mentioned in the beginning of this video, if you should know what are the events that occur into your life that will trigger a tax event that will change your outcome when you file your taxes. Your tax planning starts now. Now we are doing the 2023 tax return. Your 2024 tax return begins now, the tax planning. And you should be very proactive by going to your advisor in a quarterly frequency to talk to him. What should I do to avoid owing taxes? You're in a high tax bracket. Okay, are you putting enough money in your 401k? Right? Are you Why are you filing separately? Should you file jointly with your spouse? Do you intend to buy a property? Do you intend to get married? If you get married now, your income at the end of the year will get combined. So is it gonna be a good tax benefit for you? Should you delay your marriage? Oh yes. Should you delay your marriage for next year because you are on a 30 something tax bracket, and then your spouse gonna be on a 20% tax bracket? That's gonna shoot you to the highest tax bracket. Those are planning. Those are proactive. A phone call, half an hour for $200 per hour for half an hour can save you a lot of money. You should not be surprised if you owe taxes. You call your advisor. Is there enough taxes being withheld on my tax return? You change job. That is another taxable event. All right. You're getting a promotion, you're getting a bonuses. Is there enough taxes being withheld? All those things. You have a distribution from your 401k, or you are defaulting on your 401k on a loan that you have borrowed from your 401k. If you default, that will trigger the taxable event. The loan from that 401k is no longer a loan. They will send you a 1099 as an early distribution, subject to the 10% penalty in federal and state income tax. Those are the things that you should really be proactive. So being surprised that you owe taxes is, in my opinion, not. I think that's kind of like it's not being intelligent in a way. I mean, probably for the lack of a better word, let me remove that. Not being intelligent. It's kind of like being reckless. Being reckless. You should know. All right, because that will save you so much trouble in the future. All right. Let's see. Where are we now? There's something that I want to go over. It's about, let me see on Facebook. Am I directly on Facebook? Something that I want to go over with is, all right, filing statuses. If you look at my videos and the video that I make probably a couple weeks ago, I went over filing statuses. So and every year it's a big issue, and I think it's I mean, I do understand, because it takes time to really get to understand, to get accustomed to those technicality from the tax law. So I have many people calling, and I'm sure many of you, as a tax professional, you get this every year. Because, oh, I want to file separately from my spouse. Okay, when you say you want to file separately, that does not mean you, if you married, not default, you married and living under the same roof, the only way you can file your tax return is married filing separately or married filing jointly. You cannot do head of household. You cannot do single head of household. There are circumstances, and there are exception that the Internal Revenue will consider you unmarried for the tax year. But that's another. You should dive into the publication. I think publication 501 to see. But as the general rule, if you are married, you only can file two ways: married filing separately, which is a filing status on its own, or married filing jointly. And if you file married filing separately, is the least favorable tax filing. If you lose many credits, you lose many benefits, especially if you have a child. And also remember, if you're filing separately, the name of your spouse, not the name actually, your spouse social security has to be in your tax return. They have to match. They have to match. Because if you take whatever deduction that you take, standard or itemized, the other spouse have to take the same. Yes. If you didn't know, now you know. I'm JD, your favorite CPA. All right. What else I could think of? Dependents. I know this is a it's I mean it's there's so many the rules, so many rules when it comes to dependents. Who can you claim as a dependent in your tax return? And I know if you meet the income limitation, having a dependent can result to a big tax refund, especially people having 2, 3 qualifying child or low income. So that's a great refund for them. But for the past 5 years, we have seen an increase in scrutiny when it comes to claiming kids, also being head of household. So who can be your dependent on your tax return? Guys, I'm going to spill some beans here. Listen carefully. In order for someone to be a dependent on your tax return, matter of fact, the IRS categorizes dependents into two. You have your qualifying child and your qualifying relatives. All right. But before that, first, a person that claim you as a dependent, for instance, if I claim my kids on my tax return as a dependent, no one can claim me. That's one of the first tests. My dependents on my tax return cannot be married or filing a joint tax return. And above all, my dependents have to be citizens of the United States of America or Mexico or Canada, right? That's the general rules or test to be met for either qualifying child or qualifying relatives. Now, let's look at the qualifying child. First of all, anyone that is not a qualifying child that meet all the conditions can be a qualifying relatives. The rules are a lot. There's many nuances in it. There's many tests to be met, many conditions to be met. So let's dive in. The most common is qualifying child. The qualifying child is so common because that's where you can get the most benefits for your dependents. And if you are on a low income, a qualifying child up to 3 can result into a huge check. So it is crucial that you know what you're entitled to. However, it's equally crucial that you know what not to do to avoid an audit. All right. The Internal Revenue Code, Publication 501, that deal with filing statuses, dependence, credit, and stuff like that. In order for someone, you are listening, I'm spilling some beans here. In order for someone to be in your tax return as a qualifying child, so that you can take the following credits. If you qualify, the earned income tax credit, which is the amount goes up based on the number of qualifying child that you have. The child tax credit, additional child tax credit, dependent care credit, even adoption credit. No, adoption, yeah. So those, first of all, the dependent has to be under the age of 19. However, it can be under the age of 24 if the dependent is a full-time student. The IRS define what they consider as being a full-time student. Remember, when it comes to the Internal Revenue IRS, they have their own rules, and they establish the rules and they tell you how to play with the rules. Everything is law and calculation. So under the age of 19 or under the age of 24 being a full-time student. It's two conditions here. Either the child is under the age of 19, it can be, if the other conditions are met, or under the age of 24 plus a full-time student. The child has to be a child that lives with you in the United States for more than half of the year. Yes. And I know many tax professionals. They get this call every year. Oh, my son, my niece living abroad. They can they be my dependent on my tax return? You just failed one test, the residency test. If the child did not live with you for more than half of the year, cannot be your qualifying child, right? Of course, if the child is away to college on campus, this is what the IRS call temporary absence. Yes, that can be. If you have a troubled child that had to go to juvenile facility, that will also be considered as meeting the residency test. That will pass. Now, the most important thing, like two more, the child cannot support he or herself for more than 50%. Especially with YouTube, you have some child actor that making much more money than their parents, believe it or not. So if you have a case like that, the money the child is making, that is different. That's a very different supporting test to the qualifying relative. Now it's the child that cannot make it. I think it was the parent that could make it. Now it's the child, and that changed since 2005, and it's quite different from the supporting test of a qualifying relative. All right. Now the child cannot support his life or her life for more than 50%. Let's say the child is making $60,000 on YouTube, $100,000. If that money goes to an escrow account for the child, and provided that all the other tests are met, you still can claim that child. Believe it or not, I had a case like that. The child was 11, young, got an actor role, and she made quite a lot of money. But luckily, that money was put away into an escrow account. The parents did not touch that money, so the child didn't support herself, right? So now, when it comes to The relationship, that's where it gets a little quizzical here. It's a big quiz for everybody. When it comes to relationship, who can you claim as a qualifying child and take all those benefits? If you qualified at almost $4,000 for earned income credit, $2,000 for the tax child credit for one child, and up to $7,000 earning, up to $7,685 earn income tax credit for up to three children. Who can you claim? That's the last one of the last condition, is what the IRS call the relationship test. And the publication is quite clear. The person has to be related to you by blood, by marriage, or can be an adopted child or foster care child. By blood, let me go over the list with you here. Oh, da 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 da. By blood. All right, I cannot see. Oh, yes. To be a qualifying child, especially if that dependent will qualify you for earned income tax credit, your child must be your son, daughter, stepchild, adopted child, or a foster child. It could be your brother, your sister, half brother, half sister, or your stepbrother or your stepsister. It could be your grandchild, niece, or nephew. There's no cousin. If your cousin meet all the other tests, that will go to a qualifying relative, not a qualifying child. Right? When I say qualifying relative, it could be your parents. Your parents can be your qualifying relative. So there's no child benefits. You cannot claim tax child credit, additional tax child credit, earned income tax credit for qualifying relative. We're talking about your qualifying child. I am going back to the list again. Guys, listen up. Your son, daughter, stepchild, foster child, adopted child. That's the first category. Your direct descendant. Your brother, your sister, half brother, half sister, stepbrother, stepsister. Your grandchild, your niece and nephew. Those are the siblings of what the IRS determined to be your qualifying child. Anyone else that do not fall into the category I just said do not meet the conditions to be your qualifying child, and you are not able to claim earned income tax credit, child tax credit in whatever other benefits that comes along with that. They could be, if meaning other tests, your qualifying relatives, not qualifying child. All right. So that's pretty much what I bought for you today. Let's see if I have any question here. Is it going any question? Nope. What is it here? No question. For some reason, I'm using this platform, guys. And all right, what else? And oh, guys, another thing. If you have a child that goes to college and you're taking a loan out to pay for tuition, you either, if that child is under 24 and still your dependent, the school will provide a 1098. The credit is one of those refundable. It's partially refundable. A lot of people are saying the credit's $1,000. That's the refundable portion of it. If you qualify, remember, when it comes to the internal revenue, everything is about qualification. The credit is up to $2,500. However, 40% of that $2,500 is refundable to you as the taxpayer. What does that mean? They will use that credit to offset any tax liability, and the excess of the credit can be refunded to you. That's what it means, refundable credit. The credit is refundable partially up to 40%. What is 40% of 2,500? Do the math. 1,000. So the credit is not only 1,000, the credit is up to $2,500. But 40% of that is refundable to you. You have to, when it comes to do taxes, you cannot just use an intuitive tax software. You have to understand the law because it's a very technical. There's a lot of exception, a lot of rules, and not only that, you need to understand how everything flows to the taxpayers, uh, um, different schedules, and to arrive to the best outcome. Well, once again, I was very um, happy to bring you some some knowledge, to share some information with you, and everything is out there in the Internal Revenue Tax Code. The Internal Revenue Tax Code by itself, the source from the IRS is 6,978 pages. Just the IRS source. There's other sources also. So imagine you when you. That's why it makes the tax law so hard to apprehend fully. But that's our job here, and to know it and to share it with you. So next time I will actually come to something that actually I'm getting quite a few. A lot of people now doing Airbnbs or having a separate investment rental property, and there's a huge distinction when it comes to rental property. It's a huge area. So everybody know rental property income is passive income, and that's that's the rare case where your passive income, after offsetting your passive losses, after offsetting your passive income, when it comes to rental losses, can offset up to $25,000 your passive, your earned wages, right? And there's a limit. The phase out begins at $100,000 up to 150. What does phase out mean? Everything when it comes to the average is a bracket. So just like the phase out means at at a certain income level, you begin to lose some of those benefits. Just like for credits, earned income tax credit, it's a bracket. You know, you start losing, it start decreasing, it start decreasing. That's why you have so many times people with who had those benefits for years, and then they're changing jobs, and they're moving up the ladder with up the income ladder, not knowing that this is something that was passed to them as a social benefit that they put into the tax code. So when they see they're losing those, they don't understand. That's why when you have a taxable event, certain things that happen to you, you should be in touch with your, in my case, with me, your CPA, every quarter, at least half of the year, not the end of the year. I know we like to say year end tax planning, but the tax planning, actually, we say year end because at year end, there are a few steps you could do to, at that time, to really, really reduce or even prevent to owe any taxes by prepaying or um, um taking some step that will mitigate your tax liability. So that being said, this is JD, your favorite CPA, that wanted to share some information with you, and I hope you took a few things away. and please share, like, and subscribe. There are more and more videos coming to you this year because I want to share those information because I think it's necessary. If you understand your tax, you understand the tax, some of the tax code, some of the tax law, you can make better decision with your finance. All right. If you didn't know, now you know. I am JD, your favorite CPA. Thank you. Next time.